What is blockchain technology and how does it relate to crypto? Is it the next big thing and your once-in-a-lifetime investment opportunity, or is it a complete scam that you should avoid at all costs? Stick around and find out. Hi everyone, and welcome back to Web3 World, where we answer the most common crypto questions and make all this crypto and blockchain stuff easy to understand. By the end of this video, you'll be well-versed in blockchains, why they were created, how the technology works, and how it's related to popular cryptocurrencies like Bitcoin and Ethereum. Before we get into what it is, it's important to understand the problems that ultimately led to the creation of blockchain. So let me ask you a question. How do you know if something is authentic or not? People make counterfeit versions of birth certificates, driver's licenses, and $100 bills. So how do we separate what's real from what's fake? The answer is simple: we keep a record. Since these things all have their own unique serial numbers, all you need to do is call the owner of the certificate, license, or currency database to verify the authenticity of the item in question. Currently, these databases are all controlled by specific, centralized authorities like the government, which have complete control over validating or invalidating items. And this has its pros and cons. On one hand, having a single authority allows for things to be done more efficiently. But the downside of centralization is that this concentrated power can be abused to change records to fit a central party's desires. This is exactly what happened when the US government printed even more money to bail out the banks that caused the 2008 financial crisis. Since the record of the money supply was changed by a central authority, it affected people's trust in the banking system, and this would ultimately kick off the mainstream use of blockchain technology. Today's banking system requires trust in banks, but their past practices haven't exactly made that an easy thing to do. Take a second and think of all the money you have sitting in your bank account. Did you know that not all of it is actually there? Banks continually use the money you deposit to lend out to others. Then the banks earn interest from the loan and give you a tiny piece of the profit. And unless everybody asks for their money at the same time, the banks can keep using it for whatever they want, including making money for themselves. When the economy is in rough shape, banks are at a risk of something called a bank run, which, for example, is what caused Silicon Valley Bank to collapse recently. A bank run happens when a large number of customers of a bank or several banks suddenly withdraw their deposits at the same time. It's usually due to fears that the bank may become insolvent or unable to meet their financial obligations. And since not all of the money you see in your account exists in liquid form, bank runs can prevent you from withdrawing money. It's happened before, and it could happen again. That's why the first blockchains were created, as a response to the centralization of financial power, and with the goal of empowering you, the people, to have complete control over your money. So a blockchain is a technology that enables secure and transparent storage and transfer of data. It's essentially a decentralized digital database or ledger that records information in a series of blocks. The blocks then form a chain. Get it? Blockchain. Imagine a world where power is distributed equally to groups of people or multiple companies. This decentralization and distribution of power decreases the ability to commit fraud, manipulation, and records from being altered in any way. Simply put, blockchain technology is trying to take the principles of decentralization and apply them to aspects of our everyday lives. Think of a digital ledger as transactions grouped together in blocks. Some blocks might have 5 transactions, while others might have 10. Each block will start with a summary of the block before it, and this repetitive process ensures that the ledger is always up to date and accurate. Then, the transactions are validated through a distributed peer-to-peer network. This brings me to blockchain's 4 key features: nodes, cryptography, a consensus algorithm, and a punishment and reward system. Nodes are essentially high-tech computers that store, process, and verify transactions happening on a blockchain. Nodes are run by people all over the world and make up a peer-to-peer network instead of a centralized network. And when verifying the accuracy of a blockchain, all nodes are equal. The second element is cryptography, which is the science of encoding and decoding messages to protect information and ensure secure communication between intended parties. And thanks to cryptography, 2 people can send cryptocurrency to each other without anyone needing to approve the transaction or having to safely encode it themselves. Then there's the consensus algorithm, which allows nodes around the world to come to an agreement that the blockchain ledger is accurate. The two main consensus algorithms are called proof of work and proof of stake, which you can learn more about in this video on the screen, linked in the description below. Our fourth and final blockchain element is the punishment and reward system. When it comes to getting hundreds or even thousands of nodes to come to an agreement, having punishments and rewards gives a financial incentive for each node to act in the best interest of the blockchain. That way, if people know they'll be rewarded for running their node in a truthful way, they'll be more inclined to make sure all of the transactions are accurate. We see this with the world's biggest blockchain, Bitcoin, where nodes are rewarded tens of thousands of dollars for every transaction they accurately verify. On the other hand, there are punishments for nodes who act maliciously. So if a node signs off on a false translation, all the other nodes will be able to identify who submitted it, and the bad actor will lose a lot of money. But how are blockchains connected to cryptocurrencies like Bitcoin and Ethereum? Let's take a closer look. Like I mentioned earlier, during the 2008 financial crisis, the government stepped in to bail out banks. But the problem is, these bailouts don't necessarily prevent irresponsible and greedy bad actors from needing bailouts in the future. So in the wake of the 2008 recession, one pseudonymous individual known as Satoshi Nakamoto theorized that something like 2008 would eventually happen again, so they created Bitcoin. Their original theory was that banks and governments couldn't be trusted and that we needed a censorship-resistant, tamper-proof monetary system. The solution? Satoshi called it Bitcoin. And the goal of Bitcoin was to create a peer-to-peer payment system that allowed two people to transact with one another without having to go through a bank. Don't forget that this was long before popular apps like Venmo or Cash App, which both require third parties like banks and credit institutions. The Bitcoin network is the blockchain infrastructure that has all of the components that we mentioned earlier. The Bitcoin cryptocurrency is the actual money that can be sent across the blockchain network to multiple users. In fact, most blockchains have a cryptocurrency with the same name. For example, Ethereum's blockchain is called Ethereum, while its cryptocurrency is called Ether or ETH for short. If you want to learn more about Ethereum, which happens to be the second leading cryptocurrency behind Bitcoin, make sure to check out our explainer video if you haven't already. We'll link the video in the description. Even though blockchains try to solve some of the world's biggest problems, one question still remains. Are blockchains revolutionary, or are they just one big bubble waiting to burst? The future of blockchains is complicated, so let's look at some of the ways they're being used and whether they have any industry-disrupting potential. Bitcoin was originally created to be a payment network, but that's not really what it's used for today. Most people who buy Bitcoin aren't using it as a form of payment because it's too slow to be a global payment network. Bitcoin processes about 10 transactions per second, which isn't even as close to as fast as it would need to be to support the tens of thousands of transactions happening every second across the globe. That's why most Bitcoin buyers hold on to it like digital gold, and why it's often compared to real gold. But these next two blockchain use cases provide a whole new world of opportunity. The first one is decentralized finance, aka DeFi. DeFi expanded on the original idea of Bitcoin, but with a slightly different approach. It offers almost all of the same services as a bank, but without a central party controlling the monetary system. At the height of the 2021 crypto bull run, the value of the DeFi market reached $170 billion. This is far from disrupting the traditional banking system, but keep in mind that DeFi had only been around for 2 years at that point. The next big use case for blockchains was seen with NFTs, which stands for non-fungible token. If you've heard of them before, you might think of an NFT as random art like a weird picture of a monkey. But NFTs are actually trying to represent a new way to prove ownership of things, both online and in the real world. So in the future, we might be able to use NFTs to prove we own a car, a house, or even our identity. We'll be posting an in-depth video about NFTs soon, so subscribe if you don't want to miss it. Overall, blockchains are an innovative technology and have seen an astronomical rise over the last decade, and we hope this video helped you feel more up to speed about their potential. The future could be bright for blockchains, and if used correctly, they could help change the traditional centralized model of banking. If you found this video helpful, please don't forget to like and subscribe, or even share it with a friend. Thanks for watching, and I'll see you in the next one.